So good afternoon and welcome to the December 2022 Executive Committee meeting of the Board of Education Retirement System. It is Wednesday, December 21st, 2022, and the time is 1:06 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel following the conclusion of this meeting. We'll start the meeting by calling the roll. Gregory Faulkner.
Present.
John Matarich.
Present.
Donald Nesbitt.
Present.
Thank you. See if Allison's back. John Dorsa.
Present.
Thank you. We have a quorum. I'd also like to note for the record that alternate trustees Jerry Gibson and Nicholas Sudo are also in attendance.
And you also have Russell Buckley on behalf of the Chancellor and CFO, Sarita Scott.
See you now. Thank you, Russ. So Russell Buckley, also, we definitely have total quorum. Thank you. So the first item of business is to consider the minutes from the November 2022 Executive Committee meeting, a summary of which was included in your packets. May I have a motion to consider? Thank you, Donald. May I have a second?
Second from John.
Thank you, John. Any discussions on the November 2022 Executive Committee meeting minutes? All right. Hearing none, may I have a motion to approve the minutes?
So moved, Donald Nesbitt.
Thank you, Donald. May I have a second?
Second from John.
Thank you, John. Any further discussion? All those in favor, please say aye.
Aye, Russ.
Aye, John.
Thank you.
Aye, Doug.
Thank you. Any opposed? Any abstentions? The motion carries. The next item on the agenda is an item for discussion. The annual implementation and pacing plans. This item will be officially approved at the Board of Trustees meeting in January, such as part of the asset allocation. Before I turn it over to our consultants in the Bureau of Asset Management for their review, I did want to say a few words. One of the biggest changes you'll see is across the board that the commitment targets are lower than last year. Obviously, there's a lot to do with the denominator effect. And so I think as you're considering these your decisions over the next month, understand we're trying to strike a balance between maintaining policy without being too much outside or approaching the bands, the rebalancing bands, while also not fully underweighting any upcoming vintage years. I think just for your long-term situation, keeping that in mind. For the public markets, I think things are a little bit simpler, and I think the biggest question over the next year is going to be how much further we go in indexing the portfolio, particularly in international equity. So first, we'll have the team from Axia walk through their recommendations in private equity, real estate, opportunistic fixed income, private credit, and infrastructure. Turn it over to you, Armando. And before we begin, I note for the record that Tom Shepard is now in attendance.
Thank you, Antonio. Good afternoon, everyone. I'm hoping that someone can share the presentation.
Yes.
And I've got 30 minutes, and I know we're already 10 minutes into the agenda, so I'll try to be mindful of time and hit the key points and the highlights of the presentation. And in fact, there are 4 to go through, so I'll try to be smart about what I touch on.
All right.
If we could start with the
Absolutely.
private equity presentation.
Will do. Pulling it up right now. Second, there we go. Sorry about that. Please let me know when you see my screen.
Oh, good.
All right, great.
All right.
Antonio, if we could start with the exec summary on slide 4. Again, there's a bit to cover going forward, so I'm going to try to at least be consistent with the points that I hit, and then really get into the implementation. I think important to mention here, looking at sort of where the program is the fact that if we look sort of at the performance, which is important, as of June 30, 22, you can see the 1.7 times multiple, 14.9 times net IRR, and then beyond that, where we are with DPI. So the portfolio is performing as it should. looking at where the outperformance is versus the benchmark, a net IR of 14.9 versus 13.7 versus the Russell 3000. So I think that's a very positive thing to see for this portfolio. From there, I'd like to go to slide 6 and just for your observation, see that there have been some certain accomplishments have been made in terms of how this portfolio is implemented for this year before we go into what's proposed for next year. Looking at the managers that have been selected, Nordic and Thoma Bravo for the core portfolio, and for the emerging manager program, Light Bay and Integrum as a couple of examples. So just pointing those out to say that for the two areas of focus, I think a good job has been done in terms of diversification and how capital has been allocated to the respective fund types. From there, I'd like to go to slide 8. I won't repeat everything that's here at all. What I just do want to point out here is that, again, going back to my point earlier, as far as diversification, you can see here that managers have moved from emerging manager program to the core portfolio. Co-investments, an important focus for the group, has continued to be emphasized and underscored within the portfolios, whether it's through the Neuberger Berman program or HarborVest, and even, of course, the sort of split allocations to certain funds to get and obtain co-invest at no fee, no carry via the sidecars, which has resulted in meaningful savings overall from a fee component, which I think, again, is a great strategy that has been implemented by BAM, BERS, and other respective plans. Turning to slide 10, this is what we are suggesting, recommending for 2023. You can see here the target annual commitments plus or minus 215 million, plus or minus 50 million, and that's subject to a number of different factors, which we can touch on as we get into sort of the base case and perhaps a level of some sensitivity analyses that we did as well. But all of this is done in mind to keep the target allocation at around 9%, seeing and looking at what you're looking to do from the core program as well as from the emerging manager program. These amounts sort of break out 194 plus or minus 49 for the core program, emerging manager 21 million plus or minus 5 million for that as well. So again, overall, I think what you're looking to do, what you're observing here from a sector point of view, from a geographical point of view, I like the diversification that's intended here. Turning to slide 11, again, some of this is what I've repeated already, but again, hats off to you all for supporting an emerging manager program, because some folks put lip service to that and are sort of scared to pull the trigger. And what I'm seeing here is not only a commitment to it, but when you see funds and firms graduating from your emerging manager program to core, very positive from my perspective. Turning to slide 12. Again, a bit more of the same regarding the pacing analysis that was mentioned earlier, but I think it really helps to take us to slide 13, which will hopefully give you a sense as to what we are looking to help you accomplish after all is said and done. And the main thing is to allow you to get to your targets or maintain targets by 2027. And so based on the information that we have for the base case analysis at a 7% growth rate annual thereafter, going forward. Of course, we factored in a component for the fourth quarter of 22. We're looking at allocations for any given year. You can see here by the chart, the darker blue bars within the bar graph for each year, respectively, 335, 215, 215 across the board, 2027. As was mentioned earlier, we're seeing a slight decrease across the board due to a denominator effect. This is not unique to BAM or BERS. This is something that's happening pretty much across the alternatives industry. And so a number of folks are trying to figure out what to do with their programs as a result. As examples, do you just cut back managers, or do you cut back allocations to your key managers? And those are the kind of decisions, I suppose, that will be made going forward. My initial discussions with Anash tells me that the key managers will continue to be supported, even if in a different type of way as far as the allocations are concerned. And so that I would say is probably the better of the two moves. You don't want to cut back managers that don't make sense to, but rather reduce an allocation here and there where it makes sense. And the GPs fully understand what's going on in the market. So it will not be a blemish to anything you might be doing from a commitment point of view going forward. I'm going to go to slide 14, just briefly to show how the 14 and 15, frankly, show how the allocations change in any given year, whether it's a 5% growth rate or a 3% growth rate. Again, these are really just sensitivity analysis to help you understand what could happen if, in fact, growth rates might shift. As you imagine, and we expect and hope you'll be working with us going forward. We'll be mindful of ensuring you stay within your targets should some sort of negative impact occur that may affect growth rates going forward. Jumping to slide 16, it's an even further sort of sensitivity analysis showing a combination of a number of different factors, whether it's a 7% planned growth rate, 0%, 20% negative, 20% decline, or a 10% decline in 23. And so what this is us really intended to show is a worst case scenario, I suppose, GFC-like or that type of scenario where the program would be impacted as a result. Again, we don't foresee this happening. I just think it's important to not only highlight base case, but understand what could happen should growth rates be tweaked, changed, or be forced into such a situation based on the market environment.
So Armando, we have a question
Yes,
from
please.
Tom Shepard. Tom?
Hi, thank you. I'll keep it brief. And I dropped it in the chat. I would say, I guess for people who are not investment bankers for a living, right? And I've heard the term come up a number of times. Could you please explain briefly what the denominator effect is?
Sure.
I think, yeah, thanks. I appreciate it.
Do you have something just beyond that, just so I make sure it's factored in?
Yeah, I mean, we're talking about the denominator effect and sort of the impact on the investments we make, right? Or
Yes.
what our returns look like, et cetera. So I'm just interested in knowing what that denominator effect means in that.
Yeah, I think simply put, and apologies for perhaps not getting into the details of that, but what's important to know just in terms of where the public markets, how they performed since the beginning of the year. Broadly speaking, about a 20% decline in the public markets means overall the value of your plan in its entirety has decreased. And so if the value of the plan has decreased, and that may be the situation for some period of time, in theory, to sort of maintain the types of allocation percentages that you'd like, your allocations to private equity or any given asset class, frankly, will need to decrease as a result to sort of be maintained within that percentage range. So it's a reaction to what's happening in the public markets, frankly.
Thank you. I appreciate it. Yeah, I think I get it. Thank you.
So I guess my question would be, we will be creating a balance. Is that correct? In order to offset what the market, would we be creating a balance in order to offset what the market is doing? To just elaborate further on Tom's question.
To be clear, when you say creating a balance, what do you mean?
A balance. Are you saying that we're readjusting our investments due to what the market is doing? So are you saying that we're making less investments within a certain asset class in order to sort of balance what the market is doing? I'm just trying to make sure I'm understanding.
More the former than the latter of what you described. Reducing the amounts committed in any given annual period in order to keep consistent as a percentage with your targets compared to what the overall portfolio, the plan is doing.
Okay. Yes, I guess we're saying the same thing because I understood it that way, but you said it more eloquently. Yes,
No,
thank
no,
you.
not at all, my friend. Not a problem. Hope it clarifies some things for you.
I do have one other question. I'm
Yes.
sorry.
Sure.
So how do we, I know that in terms of returns, in the current climate that we're in, like during our trustee meeting yesterday, it was, a really bearish scenario was painted for us, right? And I guess my question becomes, our long-term targets, right? How realistic are those targets in the current environment we're in, right? So if we're making investments in certain classes and those classes are underperforming right now because of the condition that we find ourselves in, then I guess the question becomes are our targets realistic, right? Like, I guess what I'm wondering is this one of those times when we consider like not investing as much into a particular class to offset losses? Like, help me understand, because um I don't want to appear ignorant, but I also don't want to um look for opportunities for us to it's almost like I want us to not lose in an environment, right? Like there are times when we can win, but then there are other times when we like don't want to lose. And I think given what was described yesterday, I'm kind of in more of a defensive mindset.
Armando, you mind if I?
As you should be, Tom. And I would say this: what is underperforming right now, or at least underperformed compared to what we might have seen over the last 10 years, is really the public markets. And I guess sitting here, if we thought going forward the private equity markets would get slammed or underperformed in any shape or form, we would have to have that type of conversation about, well, what does that mean for how you're going to allocate going forward? But frankly, for looking at sort of what BERS is doing and what BAM is doing overall, what you're able to do, of course, is pivot as needed. And so, as a case in point, Inash has discussed with me the possibility of could distressed be an area of focus going forward? If you believe there are going to be more defaults out there within the markets, should you be able to sort of pivot your portfolio and seize the day and take advantage of the distressed market via a private equity like structure and investment? And so I would say, although the markets are having a challenge, public markets are having a challenging time right now. And you're right to ask the question about things being potentially underperforming, the possibility of us going into a recession. What do you do? The fact is, the core managers that you're backing and looking to invest with have been through certain crises, more than one in some cases, not only the GFC, but also other situations before that, where they've been able to actually prove and show out that in an underperforming market overall, a recessionary environment, any way you describe it, private equity tends to outperform. So I think it makes sense to stay consistent.
Yeah, Antonio, I just want to say this. Thank you, because you're right. And like public markets, we are for lack of better words, are getting slammed right now, right? And the private market, the private equity market is doing a lot better, right? So I definitely get it. So I think when I was talking about defensive posture, I was referring more to our investment in the public market, but we're talking right now about private equity market.
Right. I'm unable to speak to your public portfolio.
Right.
What I'm happy to say is at least you're outperforming your public benchmark.
Gotcha.
One thing I want to add one thing to that really quickly, and this is something that Steve talked about yesterday. At the end of the day, that's all on the margin. At the end of the day, we think about our portfolio in relation to our liabilities. Being a long-term investor, we're thinking about those long cycles. The duration of our liabilities is 15 years. We should the biggest strength that we had is we could take a lot of market volatility, and being able to being in a position to be able to buy when times are bad is probably the biggest strength that we have, right? Not having to be forced sellers, keeping BERS in mind in particular, where we don't have a ton of net outflows, right? So keeping all that kind of in mind, I think where we worry more about the probability of not reaching our goal versus the probability of 1 year having a down year. And so staying consistent should almost always, except on the margins, be the order of the day.
Thank you.
Yeah, I would, if I could just jump in here, I'd agree with everything that's been said by Armando and Antonio. That's correct. I mean, particularly in the private markets, you don't want to lean in and lean out. You want to be fairly consistent to the extent you can be, even though the allocations for the next few years are lower because, again, that denominator effect as the public markets have repriced lower. You still want to be a consistent investor in these strategies. In the public markets, perhaps my views yesterday is articulated. We're bearish. I think they're risk aware, but I think Antonio covered it well by saying you want to be able to take advantages when the market sells off to put capital to work as a long-term investor. Again, with a much longer time horizon. Again, looking at the liability structure, you definitely want to continue to deploy money even when the markets are soft.
Thank you, Steve. I appreciate that.
Cheers.
So we have another question from Russ.
Yeah, thank you, Antonio. Tom, to your point about the performance of private versus public, I think we're still waiting on a revaluation and the correction in the private markets that would actually really significantly help our portfolio if the private market managers would just mark stuff to market a little bit more frequently, so it would lessen the denominator effect. But I appreciate Steve's point about wanting to be consistent. I mean, this pacing plan for private equity is a pretty substantial drop, about a third of what we put into the markets last year, and dropping to, decreasing by 2/3 down to potentially 131 million if we only have 3% growth thereafter. I guess what would these pacing plans look like if we did a theoretical asset allocation, if we lived in a world where maybe there is a basket clause limit increase in the future? I guess I'm concerned if we don't get the revaluations in the private markets, if we get into a recession where the public markets drop out even further, I don't want to be forced into a place where we're selling holdings in the secondary market possibly to stay in compliance with the basket clause. If we want to reduce vintage risk, if we want to be consistent investors, I think a serious look at our asset allocations is in order.
Do that, and I'd definitely love to hear to Steve's point on this. I think for us, obviously, that's a huge consideration. And you're looking at the analysis that Axia put together, which says, all right, what will essentially break us out of our band? Like that's when things really get sticky. We have bands that are large enough in normal times, but looking like a 10% drop, a further 10% drop in the market takes us outside the bands.
Antonio, I was looking at the basket clause reporting from the comptroller. We went from having 6% space a year ago in September to having a single percentage point basket capacity at this point in time. I mean, if we get another, I think the Nasdaq's already dropped 30% in the last year. Like if the public markets drop any further, I don't know how basket clause compliance works. I don't know if the New York State Department of Financial Services is going to come down and hit us over the head with a 2x4. Like, I don't actually know how that works, but I presume that we will try to stay in compliance, and there are really only a few ways that we can stay in compliance. And I don't want to see us taking, not pennies on the dollar, but having to be in a position where we're forced to sell our holdings in the secondary market because of drops in the public equity markets.
If I can weigh in, Russ, I suspect there's a time of purchase language that applies to the basket clause. I'm not certain of that, but I believe that's the case. And you're absolutely right. You don't want to be a forced seller of a liquid asset in a distressed market when everyone else is doing the same thing. So again, trying to be consistent and still put money to work, I think is important to maintain, again, the vintage year diversification. But your comments aren't unreasonable, that we should be, obviously, and we look at the basket clause and the allocations relative to that on an ongoing basis as well. And you're right, we have come a lot closer to that 25% limit. I think the hope and expectation is that the governor may sign the basket clause legislation. It will give us a little more breathing room, but I don't have any assurance or insight other than what everyone else on the phone has, maybe with the exception of Allison. I don't know if she's got any additional insights there.
Yeah, Steve, you're not paid for the politics, you're paid for the investment, right?
Yeah.
Yeah. I mean, I guess my final point on this, and I'll drop it. I think if the basket clause is passed, if we are able to revise our allocation prospectively, like there's a world where I think that we might want to come back to these pacing plans and revise them contingent upon a new asset allocation.
Yeah, I think,
Russ, if
this
I
is
may-
Allison, just jumping in. We will know by end of day Friday latest, probably by end of day tomorrow, whether the governor is signing the basket clause bill, because it was sent to her desk a week ago Monday and the 10-day clock runs out. I think we continue to be cautiously optimistic, haven't heard any reason not to be. And I think the intent is that, yes, if that bill gets signed early in the new year, we will reach out to begin a new asset allocation process with the trustees and consultants.
And Russ, if it gives some comfort, just a couple things. One, this is the pacing plan analysis as of this point in time. And although this is presented for an annual purpose to talk about next year and the next years going forward, fact of the matter is if something shifts that's important enough for us to revisit this, at least as your advisor, not a problem. Whether it's discussed with the broader committees is another question, but that can happen without a doubt. And from what I'm hearing you say, you've got a concern, you didn't outright say this, you've got a concern perhaps that GPs are being a bit conservative in terms of marking their portfolios. And what could that mean in the end? And I think the year-end valuations will be a bit more of a telling point, not necessarily a day of reckoning. I think some have tried to be smart about how they're valuing things, but fact of the matter is, year-end valuations are when auditors get involved and third-party assessments are provided alongside portfolios to at least give them a better basis for marking where they are. And as far as being a forced seller, something tells me if the discounts don't make sense, you're not going to sell.
Well, I don't mean to rest all my hopes on the basket clause legislation, but I will for now. And thank you for stating that if something shifts that's important enough to revisit, such as a new asset allocation that incorporates increased basket clause limits, that allows us to, build in additional buffers in these areas, that we could return to these pacing plans and potentially reduce some potential vintage risk. I think that I am all for that sort of prudent analysis in the next calendar year.
Absolutely.
And Russell, if I can pile on one last thought there, I guess is the voice of institutional knowledge. In the event that we were to breach the basket, we would be required to come up with a plan to cure it. What that plan is, I think, was left intentionally vague. What it would involve, though, would be us approaching you and, of course, the consultant with some means, given current market conditions at that point in time, of finding a way to get back under 25%. DFS doesn't prescribe a particular cure period or limits to which they need us to come under that limit. I think it turns into sort of a reasonable thing, and to the extent that that popped up in your next audit, we would have to demonstrate to them that we found, a reasonable approach and moved in the right direction.
It's really helpful context, Dan. Thank you.
Sure thing.
So, Martin,
If there are no other questions, I'd like to just perhaps wrap this up with going to this particular part of it on slide 20. Sorry, perhaps one more.
21.
Yes, 21. Thank you. Looking at 21, the pacing model detail, I sort of showed the bar chart earlier, which may not be as friendly to the eye, perhaps, as looking at this chart. The upper half of this shows your commitments to be made in any given year, but I think what's also important to note here is the contributions anticipated and forecasts going forward over the next few years, but the distributions as well. And at least I'm encouraged to see that in every single case, the distributions exceed the contributions. So very much in a self-funding mode, which is exactly where you want to be when you've got a mature private equity portfolio, rather than relying on new commitments to get you where you want to be. You've got distributions coming in as needed. And as some of you may have heard me say before, DPI is the new IRR. And so distributions coming in are much more bigger factor these days than perhaps what your return might be in any given portfolio. So that's the private equity summary. And I'm happy to take any questions on there before going to real estate, I believe is next.
Any questions?
Sandy has a
Raise
question.
my-
I'll go
Yeah, I
after
raised
Sandy.
my hand. I'm just going to jump in. Armando, if equity markets are weak and fund flows into new PE shops are weak, what would you look as an indicator that distributions may not keep pace with what we expect?
I think rather than say the driver of things being weak, capital or commitments being made to PE funds is more to your point regarding a weak public environment. If that should happen, what you're going to, I think, see for the most part is a weak exit environment. And so in private equity, and I haven't looked at a number sort of recently to see what's what, but in general, an average hold is 4 years for a typical private equity holding. Now, we've seen a lot of things happen regarding investment pacing and like over the last 3 to 5 years. But that aside, in a weaker public environment, obviously there's going to be not much of an IPO market to make things happen. But also it's just going to make for generally an environment where perhaps even the private sellers are not looking to sell at a lower value that's going to be driven by public market multiples.
Is there any indication that distributions are easing off?
Not so far. It's been a pretty robust exit environment. I think even just showing by the forecast here for your base case, it's a scenario where it looks like a situation where you'll continue to at least have distributions exceeding your contribution. So you need a bit more, I would say, of a hiccup in the markets. And not to say it couldn't happen, but you need a bit more of a drastic hiccup to perhaps see distribution slowing down. But it is a tempered environment, has been this year for the most part compared to the prior 3 to 5 years.
Thanks.
Actually, Sandy, I think that's an excellent point you made, an excellent observation. So anecdotally, we are hearing that the exits probably will slow down. I don't dispute what Armando just said, but the expectation is in the coming year or two, there may be a slower pace of distributions. And candidly, on a long-term basis, I think that's a positive. You're a patient investor, you have patient capital, and we're in these longer-term structures, so you don't have to sell and raise money for distributions in a less than advantageous market.
Armando, I just had one question on slide 18, I believe it is in your packet. It's the recommended portfolio construction slide. I don't know if you're controlling what's on the screen or if someone else is. There it goes.
Antonio has it. Yep.
There you go, Antonio. I wanted to ask a couple definitional questions real quick. The table up top, the first table, long-term sector targets. These are all core managers that make up that 94.2% exposure in core managers in the second table. Is that accurate?
You mean the second table? Below?
Yeah, there's like the long-term sector targets, and then you have the emerging manager target table in the middle. I just wanted to, are the targets up top, target fund commitments, target commitment sizes, that's all core, if I'm, is that accurate to say?
Yeah, yes.
Okay, just wanted to make sure that I was understanding that correctly. And then for, not to skip ahead in your agendas, but for venture capital specifically, would that be categorized in that growth equity sector?
Well, I guess that would be done somewhat in consultation with you all in terms of how you would want to see that broken out. We at Axia, we generally cover the venture capital space alongside the growth equity space because they almost, to some extent, go hand in hand.
Thank you.
Head over to real estate now.
Sure, thank you. And I'll start again with the executive summary. And again, I think what's probably most important or very important to you all is the very last bullet point as it relates to performance as of June 30. And you can see here the performance has a net IRR of 12.2%, outperforming the PME return of 6.1%. So over 600 basis points in terms of outperformance. So I think that's again very encouraging and positive to see. Just in terms of the real estate pacing, it's a little different than some of the others we might discuss. You've got core, which is more so commitments that are made in more of a PE-like type of fashion, rather non-core. And then core is a mostly sort of open-ended funds where capital is deployed pretty much immediately. And so there's a difference in terms of how each would be modeled out. But just want to bring that to your attention in terms of how we had to think about things as the pacing is done. To go to slide 10, perhaps, then I'm just trying to hit the points that I think is important to you all. Looking at the key accomplishments here, you can see here that you're able to accomplish a number of things, whether it's your sub-strategy allocation being maintained in terms of the types of managers that you're focused on, also being consistent in terms of vintage year pacing. And as discussed before here, in these cases, contributions have outpaced distributions over the last 10 quarters or so. Again, not necessarily a bad thing. It's just a function of how drawdowns may be occurring, but nonetheless, moving in the right direction. If we could go to slide 14. Before going into sort of the anticipated forecast for the next few years or so, again, just looking at some of the themes that have come up for 2023, looking at the various markets, office market in particular continues to struggle, and distress is out there and likely to accelerate. And so there are certain managers that will take advantage of that, but it's just something to be mindful of in terms of themes that exist for next year, for some period of time. Who knows? That could be the case. Real estate and residential side is slowing, but we expect outperformance in the longer term. And retail has still had some hiccups here and there. I think it's quite evident in many respects what's happening. And so we're mindful of that as we anticipate and try to figure out how to best implement your plan for real estate going forward. Slide 16 shows exactly sort of what we're recommending for next year, looking at core and core plus, a $40 million allocation, and for non-core, value add and opportunistic, 95 million. So totaling 135 million is the anticipated amounts we're recommending going forward. To sort of use the bar charts again on slide 18, it sort of helps to illustrate how the pacing will take place for the rest of this year, looking at 65 million overall, and then 40 million over the next 5 years. So in each case, again, although it's sort of the same for each year, it helps us to sort of maintain the plan that you're looking to and the targets over the next few years. And again, keeping within those ranges by 2027. The pages beyond that, again, are more sensitivity analyses for each of the categories. I would, again, probably go to slide 29 to turn the bar chart presentation to sort of more numerical for your purposes, where you can see the commitments to be made in any given year compared to the contributions and distributions. So in some years, perhaps not quite self-funding, but going forward with the distributions that you see here, looking better from a pacing point of view compared to the contributions. Happy to take any questions on real estate before moving over to opportunistic and fixed income side.
Any questions for Armando?
I don't have any questions. I'll just kind of comment for my fellow trustees that I think the same concerns that I raised about the pacing plan for private equity are likely going to, impact every single one of these private market pacing plans. 135 this year. It was 200 million last year. We only got 170 of it. So I just think as we continue to look at our portfolios, as we continue to look at our asset allocation in the context of legislation, I would strongly encourage my fellow trustees to be engaged with an asset allocation process at the conclusion of basket clause legislation potentially being signed by the governor, and would then subsequently encourage fellow trustees to think about these pacing plans and the potential revision of these pacing plans to ensure that the BERS portfolio is as strong as possible.
Absolutely. Thank you. Any other questions before we move over to OFI? All right. Ando?
Okay. I'll start this presentation a little bit different. It starts writing with the implementation plan. So if we go to slide 3, you can see here the target annual commitments suggested are 150 million plus or minus 30 million to maintain that target allocation of 5%. And it's important to mention here, it makes perfect sense that what needs to be taken into consideration regarding this are macroeconomic conditions. We've talked about this for the other asset classes, but for this one in particular, and I mentioned distressed and the like, depending on what's happening within the markets, one could pivot or move in different directions. And so again, there to advise, there to help over time as we think about how things should be going on within the OFI portfolio going forward. Turning to slide 5. Again, sort of very similar in terms of what you've seen here, the pacing analysis for the base case and what we are suggesting here. The rest of the year plays out to be 170 in total for 22 and 150 per year to help achieve the target that you're looking to have here at 5%. And so we are, again, this will be discussed over time, but this is where it looks as of today, and the portfolio growth anticipated going forward. The next few slides, again, are a pacing sensitivity analysis with a 5% and 3% growth rates. But again, I think what's important to sort of highlight here, just want to get to the same slide I've shown before. Slide 9. Again, just helps to illustrate outside of the bar graph component how you can expect things to look going forward from the commitments made each year, as well as contributions and distributions. I'll pause here for any questions you might have regarding the analysis for OFI. If there are no other questions, I'll move to the real estate presentation.
Infrastructure.
Infra, sorry. Thank you. And again, what I've tried to do, at least if it helps, is be a bit more detailed in the first presentation and sort of let you know what it makes sense to hit for each of these. But happy to sort of, if not during this presentation, happy to take any follow-up questions at that point, at a later date, if need be. We could go to slide 5 for infrastructure. Again, just to sort of bring you to the performance side of things, you can see you are outperforming yet again the BERS infrastructure portfolio at a net IR of 12.7%, outperforming the various benchmarks that you're measured by, which is again very positive. So checking all the boxes as needed when it comes to how this portfolio is measured. So that's very good to see. If we could go to slide 9 and look at some of the accomplishments achieved throughout the year. Again, won't sort of go through this, but just to bring your eye to this slide that a lot has been done in terms of where you are within this portfolio. And so some smart things done, whether through funds or co-investments, I think have been positive for the overall, for the infrastructure portfolio. The next slide shows slide 10, just exactly where some of those commitments have been. So again, overall, although 5 commitments, 5 very good commitments within the infrastructure space. Turning to slide 12, talks to the implementation plan. Again, 125 million in terms of annual targets, plus or minus 25 million to achieve and maintain that 4% mark is what we are recommending. Turning to the next slide, slide 13 shows potentially how that could be done. Looking at the second bullet point, 30 to 50 million up to 3 to 4 funds. So not too far. If 5 were done for 22, 3 to 4 for the outgoing years still allows you to be pretty much consistent. And turning to slide 14, you can see here again the same base case analysis with the 7% growth rate, how this sort of plays out for your portfolio going forward, looking at commitments to be made each year and how they compare to the net asset value allows you to maintain those targets overall. And again, this can be fluid, and we can always discuss as your advisor what's important and if there are other shifts that might be needed to better take advantage of the markets that could be coming up over the next, say, 12 to 24 months. The last slide I will go to is slide 19. Same one I've sort of ended on as before, that illustrates whether you're sort of making commitments between 100 to 150 million a year. This is sort of how it would play out for your contributions and distributions over time. And so these are the flows, the net cash flows of the infrastructure portfolio forecast through 27. So again, I think it's not too far from what we've discussed already, but I think overall, looking at each of the respective asset classes touched on, the portfolio, just based on the fact where it's performing versus the public markets, are doing pretty well. And I think just in terms of how you're looking to do things going forward for 23, the forecasts are not out of question. And I think even with the sensitivities that we've run, it's a well-built portfolio already that we just need to sort of make sure is maintained going forward. So I'll close my comments. I'll end at this point, but happy to take any questions on any of the presentations at this time.
Any final questions for Armando on the pacing plans?
Yeah, Antonio, thank you. If I could just to kind of in conclusion, I think that this stuff is some of the most important decisions, and it underpins all the work we do for the entire year, right? So I think understanding what's happening with these pacing plans is like the peak responsibility of investment trustee if you're going to think about this stuff critically, right? I guess, Armando, obviously every single one of these private asset classes, we're dropping our pacing by about a third or more. I wanted to ask kind of how you think about, it's a question of consistency, right? And vintage risk. Like how does an investment advisor like yourself think about the long-term risk of vintage risk and increasing and decreasing the pipeline and projected commitments over the course of a 10-year plan? I mean, is it a question purely of maturity and getting like a cash flow neutral self-funding portfolio and just trying to maintain that at a given percentage of your portfolio over the course of time? Or I'm curious just to kind of, on all of these asset classes, not just infrastructure, because I think that question pertains to all 4.
So if I understand the question, I'll try to answer it. And please, if I'm answering it incorrectly, just help me clarify. Yeah. From a vintage year diversification standpoint, to answer that question, that is very important, almost critical in some respects. You commit to a fund, you expect it to perhaps not utilize a full 5 or 6 year investment period, but take enough time to perhaps put that capital to work over a smart enough amount of years, whether that's 3 to 4 years, and diversify accordingly. we've seen huge deviation of that for a number of different private equity managers over the last few years, because it's been just a robust deal market that they've been taking advantage of and coming back to market much more frequently than they have in the past. So we are very mindful of that as a whole when we think about underlying managers and how they're doing things. And it's something we'll always bring up in any board presentation that we'll discuss with you all. But to your question regarding specifically as it relates to your plans and doing things and being consistent, I think you've heard across the board, whether it's from Steve or myself, Antonio, consistency is important for a number of different reasons. You'll find at times, and it just depends on the environment, if you skip a fund with a brand name manager out there, core manager, they may view you as a defaulting type of limited partner, and then you don't have the opportunity to do the next fund. If you reduce your allocations too much, that also, I don't think it's not a black eye in terms of how a GP views a limited partner, but you do want to have some level of consistency as it relates to, and it's came up earlier, the asset allocation overall within a given portfolio. And so if private equity is intended to be 9%, you probably want to try to be there as best you can. And I think just pick your spots. And if large cap doesn't make sense and middle market does, so be it, then make a change and move accordingly. But still, I think overall consistency will serve a portfolio well in the end.
Yeah, thank you. It's the give and take between GPs and LPs is interesting. And also the comment on the robust market for fundraising over the last couple of years. I'm thinking specifically about, like, just say these are the pacing plans, right? We've had monster fundraisers or monster commitments over the last couple of years, and now maybe we're looking at a couple more lean years. I guess, I don't know, is there like a feedback loop within the pacing plans to the asset allocations to think about, okay, hey, we just put $600 million into infrastructure over the last 3 years, and now we're only going to put $100 million into infrastructure every year for the last 3 years. How do we think about the risks of that portfolio versus the portfolio that we're trying to put to work in the next 3 years? I'm trying to put a little bit more of a framework around the vintage year risk that I'm cognizant of, and that's kind of the whole point of pacing plans. But, like, great, now what? Like, what do we do with that information?
Well, I think it's, again, I do want to underscore that this is looking at the pacing as of today.
Yeah.
And this will be revisited fully a year from now. And so let's pick, infrastructure, I think it was a 150 a year, and sort of it stays the same every year thereafter. That's as of now. I'd like to think that the public markets, let's hope so, will come back in the next 12 to 24 months. Hard to predict, but at that point, you don't have a denominator effect you're dealing with. And that changes things in and of itself. And so your question makes sense as far as consistency, but I would also say it's hard to time the market. It's hard to sort of catch the right things at the right point in time. And so I would say let's just be mindful of how the markets are shifting. Let's also understand that these annual pacing plans are not written in stone. And if things should shift regarding the basket clause, if things should shift regarding the denominator effect, we will immediately run this pacing analysis for you and decide how it makes sense to move forward from those points on.
Yeah, that all makes sense. And I think, Sandy, I'm kind of trying to piggyback on your question a little bit earlier about what was it in particular, like forecasting distributions, and maybe the thing that I'm thinking about is more retroactive than prospective. So happy to take this conversation offline, but I appreciate you entertaining my philosophical questions here, Armando.
Absolutely.
Actually, but before you get past the philosophical, could I just take 3 minutes, Antonio?
Sure.
So we are starting to make decisions which have 5 to 7 year impacts, right? And there are more dimensions to the question of how we manage these allocations than just what happens next year. And some of the things that we are going to have to be responding to are, one, our funded percentage. We are effectively 100% funded. So the question is, how much risk do you take? Two, we are a leveraged fund. We are structurally leveraged by the TDA fixed account, which is about a 28% leverage factor, which you mark to market on an economic basis is close to 34% leverage, which is why we went from 120% funded fiscal 2021 to 100% funded fiscal 2022, and the market was only down 9%. Okay, so leverage. And then finally, cash flows. We have been upside down for 4 or 5 years. Upside down means more money going out than going in, right? Our contributions from the city peaked 3 years ago, 4 years ago, a little over 300 million. They're now falling well below 200 million. They're expected to go to zero. Listen to this closely, zero at the end of the decade. And that means we are going to be looking at making commitments against the need, the requirement that we make asset distributions in order to fund private equity investments potentially. So, you know, we have to watch this extraordinarily closely. Extraordinarily closely. It's a 3 or 4 dimensional problem.
Thank you,
I'll shut up.
Sandy.
Thanks.
So I think fiscal year 2020 was actually the last year that we were cash flow positive. So we had like 2 years. But the only thing I'll add to that is
Far worse than I remembered.
No, it's a little bit better. But and the only thing I'll add to that is you know, we have a big decision around international equity coming up. Obviously, international equity, unfortunately, after 10% takes up part of the basket clause, a lot of room, right? And our target is 6% of that precious 25. And so that also keeping that in mind as we are thinking about asset allocation. But thank you, Armando. Thank you, all trustees, for your questions. Again, this is for discussion. And instead we won't bring the actual to a vote until the next board meeting. So we actually have one more opportunity for discussion at the next January investment committee meeting before going to the board for final approval at the end of next month. Right. So that is the only item for that's the next items are on the agenda are discussions on individual securities or investment funds for consideration. Those discussions belong in executive session. May I have a motion to enter executive session?
So moved, Tom.
Thank you, Tom. May I have a second?
Second, Greg.
Thank you, Greg. Any final discussion for public session? Right. All those in favor of entering executive session, please say aye.
Aye.
Aye, Russ.
Thank you. Any opposed?
Aye, Tom.
Thank you. Right. The motion carries. We are now in executive session. Karen, can you please pause the recording? Turn the cameras on.
Okay, the cameras are back on, Antonio. You may proceed.
All right. So report out. In executive session, the executive committee discussed its excluded securities list for approval at a later date. The executive committee also approved 2 commitments in the private equity portfolio and 1 commitment in the opportunistic fixed income portfolio. Finally, the executive committee tabled its commitment in the private equity portfolio. Before we adjourn, I want to remind everyone that the next meeting of the executive committee is scheduled for Thursday, January 19th, 2023 at 1 p.m. That's everything we have on the agenda. We now need a motion to adjourn. May I have a motion?
Before we adjourn,
Yes.
I just want to wish everyone a safe and restful and joyous holiday season.
Thank you.
And with that,
Thank you.
I move to adjourn.
Thank you, Tom. Second.
Yes, thank you, Tom.
All right, thank you. Any discussion? All those in favor of adjournment, please say aye.
Just
Aye.
log on.
All right.
Happy holidays.
Opposition. We are
Thank you.
adjourned.
Happy holidays.